Hey there, welcome back to our series on decoding financial statements. In this video, we're going to be tackling one of the most misunderstood but powerful reports in your business, the balance sheet. It shows you three critical things: what your business owns, what it owes, and what's left for you. So stick around because I'll walk you through real examples and show you how to spot financial red flags and opportunities. So let's jump in. Let's start from the top. What actually is a balance sheet? So our profit and loss shows you how much you've earned and how much you've spent over a period of time. Like a movie, it shows income, expenses and profit. Your balance sheet, however, shows what you own, what you owe and what's left for you at one single point in time. Like a photo, it shows you what you own, owe and your equity. And your equity is your financial interest in the business. So if I said, this is your balance sheet as at the 30th of June, I mean it's a snapshot of your business's financial position on that exact date. Your balance sheet will be used for finance applications, credit applications, and your business valuations. The way that the balance sheet fits together is a formula, and this formula is assets equals liabilities plus equity. And this formula is the core of the balance sheet. So let's break that down. Assets are what your business owns, like cash, stock, equipment, or outstanding invoices. Liabilities are what your business owes, like bills, credit cards, tax payments, or loans. Then equity is what's left for you as the owner after subtracting what you owe from what you own. And this will be the accumulation of profits plus what you've put into the business less what you've drawn out. So if your business has $100,000 worth of asset and owes $60,000 in loans or payables, then your equity, what's left for you, is $40,000. Think of it like a house. If your house is worth $1 million, you owe the bank $500,000, then your equity in that house is $500,000. And the same concept will apply to your business, only instead of bricks and mortar. So why should you care about your balance sheet? Because your balance sheet shows you how strong your business is financially, how risky your debt position might be, and whether you're actually building value in the business, not just chasing sales. It's not just for your accountant, it's for you, the business owner, so you can make confident decisions with your money. Now let's take a closer look. Assets, what you own. Assets are everything your business owns that has a value. So that might include cash at bank, your accounts receivables, which is invoices you've sent but haven't yet been paid for, stock or inventory, equipment, vehicles or property. So we have an example here of current assets of $18,000, accounts receivable of $12,000, stock of $8,000. And then we have some non-current assets. So these are assets we're going to have for more than 12 months. So equipment of $25,000 and a vehicle for $15,000. So our total assets are $78,000. And then we have what our liabilities are. So liabilities are debts or obligations, which is money you needs to pay. So it will include things like your credit card or bank, unpaid supplier bills, accounts payable, loans or leases, GST or PAYG. In our example, we have current liabilities of accounts payable of $10,000. We owe the tax office $5,000 and a loan for $6,000. Then some non-current liabilities for $14,000, giving us a total liability of $35,000. So then we come to equity, what's left for you. So equity is the leftover value after paying off all your liabilities. It shows the owner's stake in the business. So this will include your retained earnings, which is profits that you've left in the business, what you've put into the business, and what you've taken out of the business. So in our example here, retained profits that we've left or retained earnings in the business of $30,000. The owner's put in $20,000 and taken out $7,000. So if we go back to our formula now and apply it to our example, we've got $78,000 worth of assets, less $35,000 worth of liabilities, gives us $43,000 worth of equities, which is what we have in our equity section of the balance sheet. So we know that everything balances and has been accounted for. So now let's have a look at why the balance sheet matters. And here's why you should care. It shows if you are building real value over time, increase in your asset values and decreasing in your liability values will increase your equity. So it will show you if your business is actually increasing in value at any one time, or over time, I should say. It tells you how much cash cushion you have. It helps with finance application. It identifies if you're borrowing too much or not investing enough in your business. So there are a few red flags we need to watch out for. And the first one is negative equity. So this means that our interest in the business is actually reducing. So we've actually, what the business owes us is reducing, and that's not a really good sign. We may have high receivables but low cash, and that would indicate slow paying customers. So often we're so busy chasing sales and new customers, we do the work, send out the invoice, but we don't follow up. Another flag is large tax liabilities unpaid, such as PAYG withholding, which is tax for your employees, or GST, or large unpaid superannuation balances. So if we've got growing liabilities but stagnant assets, it would indicate that what we owe is growing quicker than what we own. So here's some tips on how to use your balance sheet monthly. So because it's a snapshot at a point in time, we want to compare balances month on month. So if you see a trend that your equity is diminishing month on month, it would warrant further investigation. We want to check if our receivables are growing too fast. You might be funding other people's cash flow. And we want to keep liabilities like tax and superannuation and loans under control. We want to make sure that retained earnings are increasing over time, which means our business is growing in profitability. And you may also have heard about the KPIs, or key performance indicators, that you should track within your business. So I've summarised a few of the most important ones to track in your business and what they mean. The first one is a current ratio, which is your current assets divided by your current liabilities. This measures your liquidity, how much cash you have available, and your ability to pay short-term debts. So we want to make sure that's greater than 1.2. The next formula is debt to equity. This formula is total liabilities divided by equity. So it shows you the current risk level, how much you owe versus how much you own. And in the calculation, we want to be lower. Lower is better. Our net profit margin, which is our net profit divided by our revenue times 100. So that will give us our profitability on the percentage of sales left over after expenses. In the last video, I talked about your gross profit margin, but your net profit margin will be the bottom line margin. The higher, the better. You can always benchmark your business against other businesses to see how you're actually performing. And then we have accounts receivable days, and that's your accounts receivable divided by your sales times 365. And that measures your cash flow efficiency, how fast customers pay you. So the lower, the better. And then we have a return on equity, which is a pretty standard formula, which is your net profit divided by equity times 100. So this will show you what you're actually returning. So if your business is returning 25%, well, that's great. You invest money elsewhere to get that type of return. Or it's, on the other hand, very low, then maybe there's some things that you need to have a look at. So let's recap on what we have covered. So the balance sheet basic, it's your financial position at a glance. Use it to understand your business value. Watch for the warning signs. Review it monthly with your accountant or advisor. And remember, you can't grow what you don't track. Your balance sheet helps you build wealth, not just chase sales. So if you've made it this far, awesome job. Understanding your balance sheet gives you power as a business owner. Hit like and subscribe for the next video, where I'll be talking about cash flow clarity and why profitable doesn't always mean cash rich. Drop a comment if you want me to review your profit and loss or balance sheet layout, or help make sense of them, and I'll see you in the next one. Bye for now.